You know what separates traders who crush the open from traders who get crushed by the open? It's not speed, it's not some secret indicator. It's knowing exactly where to look and exactly what you're looking for. Today, you're getting the exact two-part structure I use to trade the open cleanly and consistently so you can stop guessing and start entering with confidence. And once you see how simple this is, you'll wonder how nobody showed you this sooner. Now remember, simple doesn't mean easy, and it still means discipline. But if you know what to look for, you've got a much better chance. Here's your early move predictor: pre-market highs and lows. For traders who are not looking at the pre-market high, pre-market low, and the previous session close each morning, let's start with a quick look at why this is powerful and a practice that will improve any setup. Price action on a chart is actually a map of human behavior. If we can see what levels that triggered selling, we can see the levels that triggered buying, we can look at those levels going forward as reaction levels. The only reason anyone draws a line on a chart is the belief that there will be a reaction there in the future. This includes support, resistance, demands, gaps, and even trend lines. Each morning, I start with something as simple as the previous session close, which is the 4 p.m. Eastern cash close of the previous session. Really simple, right? This is one of the most powerful levels a trader can start with. It's a sentiment line. It's a line in the sand. Above this level, price action is generally going to be supported by buyers. And below this level, price action will typically be sold or resisted by the sellers. Think of it as bullish versus bearish sentiment. That shift to only buying above the previous session close and looking for shorts only below the previous session close increased my day trading win rate by about 15%. And if you think that's not a lot, consider what having 1 to 2 fewer losses per session would mean to your trading. Successful trading is not a massive shift, but rather small changes that add up. Losing traders look for an upheaval of their process. Winners look for small, positive tweaks that add up. Here's why the pre-market matters, but maybe not for the reason you might think. Far too many traders think that the pre-market indicates or foreshadows what the cash session will do. And most of the time, it is really about understanding that there will be a character or structure shift once the bell rings, not continuation, not more of the same. I've seen this pattern play out again and again for over 3 decades. It's why I can spend about 1 hour a day day trading in the morning and have a win rate of approximately 65 to 70%. Do we lose? Absolutely. But the whole idea is 2 concepts. Number 1, your average winner should be greater than your average loss, and you want to have a win rate of at least 60 to 65%, which is just a little bit better than a coin toss. I do not expect the same structure that occurred before 9:30 to happen after 9:30. That's a huge shift. Early price action shows the character of the morning. Was it choppy? Was it narrow? Was it in a trend? Pre-market can be defined from a couple of different places. You can look at the pre-market from the Asian session forward, which is roughly 8 p.m. Eastern. You can look at it from the UK session forward, which is roughly 3 a.m. Eastern. Or you can look at 7 a.m. Eastern, which is generally the early part of the New York session when the volatility and the volume slowly starts to increase. And the market characteristic during that time, whichever pre-market you choose, is not foreshadowing what will happen at the bell. It actually tells you what is not likely to happen at the bell. See, a pre-market trend or a pre-market chop, understanding which is happening before 9:30 allows you to eliminate what is most likely not going to happen after 9:30. So for example, if you see a pre-market trend, the US is likely to chop or stay range bound in the first couple of hours of the morning. If you see a pre-market range, the US after the bell is likely to break out of that range, perhaps even trend. The pre-market character gives you the first structure of the day, and understanding it is important because there will likely be a shift in character after 9:30 as opposed to what was happening in the pre-market. This is why marking levels helps. It helps us identify whether a market is chopping or trending. It creates clear boundaries before the open. Boundaries are where the power shifted from sellers to buyers or from buyers to sellers, leaving behind support and resistance after the battle. It also lines up with how the algos will scan for liquidity, because at these levels, there is often volume and can commonly be ripe for those liquidity sweeps. If you want to know there's volume at a certain level that happened pre-market, take a look at volume profile. So how does price behave at or near these areas? It almost always interacts with them. In fact, they can often act like a magnet. Reactions reveal acceptance or rejection. Acceptance means price can follow through. Rejections mean price won't be able to follow through. And this matters a lot since about 90% of retail traders are actually momentum traders. They are expecting follow through past resistance or follow through past support. And by the way, they're the ones most likely to get caught up in liquidity sweeps. So predicting direction means we can use a few tools. One of them are gaps. These levels are often accompanied by 3 soldiers, 3 black crows. These are often also known as fair value gaps, which tend to pull back to about 50% of the pattern's range. There are 3 types of gaps I look for. At the end of the day, gaps are just support and resistance. A range gap are the most obvious because there's no connection to the close of one candle to the open of the next. It's literally a hole on the chart. In the case of a true gap, it will open outside the previous candle's range. And lastly, there is a price gap. And this one's easy to see with simple Japanese candlestick formations. And I prefer when there is a Marubozu or a dominance candle within the second candle of the pattern. For those of you unfamiliar with a Marubozu candle, this is a candle of unusual size, which is 1.5 to 2 times larger than the average size of the 5 candles that preceded it. With this candle, look for price to close the price gap at the center of the dominance candle. In other words, a 50% pullback or a half back. And that's it. That's gap 101. Once you recognize them, you won't miss them. Here's why gaps matter. They reveal moments of institutional aggression. It's extreme demand or supply. They show where price skipped normal negotiation. If the demand is high enough, price will jump through levels where there were no sellers willing to take the other side of the trade. The types of gaps we're dealing with are just 3 kinds. A true gap shifts the market into a new zone. A range gap shows fresh intent inside the range, and a price gap marks hidden pockets of imbalance. So here's how gaps can guide your direction. They confirm strength when they're defended. In other words, a gap up can continue to go because buyers and support were there. They expose weakness when they pull back and fill. So a gap close or the 50% pullback of one of those Japanese candlesticks. Now, when you want to control risk, there is one candle to know, and that's the power bar. You can control risk in massive volatility with a power bar, and a power bar is simply a large candle. This is where the open and the close are both close to one end of the range, showing decisive buying or selling and little intrabar disagreement. The Japanese candlesticks that reflect these power bars are called a Morobozu. A bullish Morobozu opens near the low and closes near the high, indicating buyers controlled that candle, and often appearing in breakouts or strong moves higher. The open and close are at or very near the extremes of the session. So the candle looks bald or shaved. It doesn't have a shadow or a wick. This signals strong conviction and momentum. So traders will often treat the higher low of the Morobozu as reference for support or resistance. So what defines a power bar or a Morobozu? It stands out clearly in the size, and it often is going to accompany the open and news, also data releases. And it's going to be about 1.5 to 2 times the size of the 5 candles that preceded it. The candle shows coordinated participation and preferably volume. Ideally, the candle forms and acts like a black hole swallowing up size as it moves through illiquid levels. That's why it can move so easily. There's not a lot of size in the way. The close of the candle matters a lot. It needs to finish near the extreme. The place it closes should also reveal where sellers were willing to take the other side of the trade, despite that extreme volatility. But it is important not to assume the move is complete just because of the candle close. It can confirm conviction in the direction if there is not a doji or a minor high that forms in the next few candles after that large move. Remember that candle closes are actually arbitrary based on the interval of the chart. The candle close simply means the next candle is forming, not that the momentum or feeding frenzy is complete. Here is where it must form, right at the pre-market boundary. Patterns themselves are only as effective as where they form. Traders get frustrated when they look for gaps or these patterns and not where it started from or where it ended. It's not the move alone. It's not the pattern alone. It's where price was able to travel through. Was it able to take out a large volume node? Did it speed through low volume nodes? These are signs that the candle was a legit psychological phenomena that we can now use for support and resistance. So targets beyond the opening noise. The power bar can help predict zones, support, and resistance. Back in my forex days, and I've been trading forex since late 1999, and I've written 3 books on the topic of forex trading, I would look at these candles on a 4-hour chart, and usually with the London Open, which was the biggest session within forex, still is, which means the 4-hour candle of large size took place while Europe, the UK, and Asia were overlapping for a brief time. That's 3 major financial centers. For the stock market, focus on the index that the stock trades within. If you're looking for a power bar, say in NVIDIA, it will likely start with moves in the NASDAQ futures. And it'll be seen in the semiconductor ETF, SMH, or the technology ETF, LK, both of which are heavily weighted with NVIDIA. Let's talk about the primary target. Aim for the opposite pre-market level, the 4-hour candle range if it was a Morobozu. These are reliable paths for the range traverse trades. Remember that the market structure, the character of the market matters a lot. So if the structure is a trend, look for a pullback and then for the trend to resume. If the structure is still choppy, look for the move to exhaust at resistance and pull back. Structure will dictate strategy. If you're a trend follower, start with identifying if it's a trend. If you like oscillating markets, make sure you're trading in chop. The next thing is the gap target. Use the midpoint of the power bar or the Morobozu. It acts as hidden support and resistance, especially at that halfback or 50% level. What about secondary targets? An anchored volume-weighted average price later in the session can be used. Previous days' high or lows can be used. And if you're looking at continuation trades, you can look at a mean reversion. Here's a big one, entry discipline. Wait for price to hit the level. Wait for the power bar. Wait for the confirmation of entry. Make sure you know what the underlying market structure is. If there's one thing I want you to take away from this, it's that structure beats speed every single time. Process is how we win. The market open becomes manageable the moment you commit to these pre-market levels. Wait for conviction to form in the form of a power bar or other Japanese candlestick, that you use gaps to stack the odds in your favor. Use the process. I've included some helpful links in the description to support your learning. And listen, if you're ready to stop guessing and start trading with real structure, with real process, my live trading room is open. This is where you get to have a time-tested, personalized plan with someone who understands exactly where you're stuck, because I've been there, and I'll help offer a clear path to becoming the trader you know you can be. No more overwhelm, no more watching everyone else's success while you're still struggling. Just clarity, confidence, and a consistent process.